Hey, thank you so much for checking the channel out. My name is Agabus. This is your financial education channel. Today we've got an article regarding money printing from the Daily Hodl. Billionaire Ray Dalio warns more money printing coming for U.S. amid rapid debt accumulation. If you don't know who billionaire investor Ray Dalio is, he is the founder and CIO of Mentor, a global macro investor for the last 50 years, founded Bridgewater Associates out of his two-bedroom apartment, ran it for most of his 47 years there, building it into the largest hedge fund in the world and the fifth most important private company in the U.S., according to Fortune magazine. So if anybody's we're going to listen to Ray Dalio. This week, speaking at the All-In Summit, Dalio says, with the country's rising debt limits, the billionaire says that the recession could force the government to reintroduce quantitative easing, which, of course, is a monetary policy that aims to increase the money supply of dollars into the financial system. Ray Dalio says, quote, "What happens is debt rise is relative to incomes." What that means, mechanicalistically, is that debt service payments rise relative to incomes, and so it squeezes out consumption as the debt compounds. What happens is there's a realization that they have to print money. I think you're going to see in the next downturn another move to print some money. According to the U.S. Treasury Department, the country's national debt stands at a little bit over $33 trillion, which just happened this week. We'll take a look at something in just a second here to dive deeper into that. Dalio says also that there's a big risk looming for the United States. That has been a continued trend here on this channel. More and more people are saying the same thing here. The billionaire notes that the U.S. bondholders may see it fit to liquidate their holdings if the value of the bonds decreases due to money printing, which, as we all know, it will decrease due to money printing because of the inflation rate with the money expansion. When the U.S. government prints more dollars, the value of the currency declines as more money is pumped into the system. That's what I just said. Dollar debasement is also what it's called. It tends to lead to a decline in the value of U.S. bonds as investors realize they can buy less with the interest generated by the government-backed asset. Ray Dalio says the big risk comes when they don't want to hold those bonds anymore because of supply and demand, because when a country has a deficit, it has to borrow, and so it sells its bonds. Who are the bondholders? Why do they buy? The buyers of bonds buy because there's an attractive return. Not only do you have those amounts of bonds, but when they start to realize that they're not getting good returns for those bonds, then they can and probably will sell those bonds. What Ray is trying to say here is that if you have a bond, let's say it's $1,000 and it's giving you 1% a year interest, and at the end of 5 years you get all your money back plus 1% along the way. Well, when the government prints and expands the money supply more than 1% a year, at the end of the term, your $1,000 isn't going to go as far. You can't buy as many candy bars as you could a couple years prior. So when the money supply expands, the cost of living goes up, also known as inflation. To piggyback off of that, just this week, the U.S. debt rises to $33 trillion, just as a government shutdown is looming. This is from CNN Business. Let's take a look at this article. As the U.S. national debt passes $33 trillion and a government shutdown looms, Wall Street starts to feel defensive. A few weeks ago, Fitch sent Congress a wake-up call. After the debt limit fight earlier this summer, the ratings agency downgraded U.S. sovereign debt from AAA rating to AA plus in August, citing the nation's mounting debt and partisan brinkmanship as the major reasons behind its decision, also known as politics. But the government decided to hit the snooze button. So what's happening? Well, the gross national debt has grown at an alarming pace since then by $1 trillion in the last 3 months alone. Let that sink in. $1 trillion the debt has grown in 3 months. The budget deficit, which is the difference between what the government spends and what it takes in, i.e. through taxes, reaches $1.5 trillion for the first 11 months of the fiscal year, which is an increase of 61% from last year. So far, things are not looking good for today. Also, the recent increase in interest rates has made it much more expensive for the government to pay back what it owes to the central bank. And a shuttered government without a plan for how to pay back its debt would make the problem even worse. Continuing on here and concluding from Yahoo Finance, this is just compounding today. But listen to this, $7.6 trillion of the U.S. government debt will mature in the next year, adding pressure to rates. As I mentioned in the previous article this week, when the government debt matures, it means that it's due. Someone's got to pay that back. If the government doesn't have it, or doesn't want to pay it back for that matter, what they'll do is they'll print more money, create more bonds in order to repay the previous payment, which you can think of it as refinancing one maxed out credit card for another credit card. But the new credit card has a higher interest rate. Now, $7.6 trillion of interest rate bearing U.S. debt will mature within the year, which is 31% of U.S. government debt. Still below 2020 when the debt matures, but I don't know if that matters too much. So nearly a third of all outstanding debt is now set to mature in the next 12 months. The article says that the $7.6 trillion coming due is one source of upward pressure on U.S. rates. And the reason, and I'm assuming they're referring to the yields on the bonds, because as people dump the bonds or don't want to buy the bonds, the value goes down, which means that the yield on that bond, which is now sub what it's sold for, is a higher percentage payout in regards to what the bond is actually worth. As of Friday afternoon, the 10-year Treasury yield stood at 4.25 and a 3-month yield at 5.47%. Rates have been under pressure from the Fed's quantitative tightening program, which removed a top buyer from the bond market. The central bank has allowed $1 trillion of its debt holdings to run off of its balance sheet. That means that they're basically destroying money, where the money supply is now contracting. Fun fact, last time the money supply contracted this quickly was during or before the Great Depression. So would love to get your thoughts on what seems to be a ticking time bomb when it comes to money printing. How are you planning to secure and protect your wealth? Are you buying hard assets? Are you buying soft assets? What are you doing in these final days, it seems like? Thank you so much for watching. Make sure to stay informed, stay inquisitive, and stay subscribed for more. My name is Agabus, and we'll see you tomorrow.